Donald Trump averted a transatlantic tariff war involving stiffer rates on both sides as it announced a deal with the European Union after meeting Ursula von der Leyen, the president of the European Commission, at his Turnberry Golf Resort in Scotland. The agreement includes a 15% tariff on most EU goods. That's about half the earlier threatened rate, and comes with European commitments to buy American energy and military equipment.
Allow me to go into some details. We have stabilized on a single 15% tariff rate for the vast majority of EU exports. This rate applies across most sectors, including cars, semiconductors, pharmaceuticals. This 15% is a clear ceiling, so no stacking, all inclusive. So it gives much needed clarity for our citizens and businesses, and this is absolutely crucial. Today we have also agreed on a 0-for-0 tariffs on a number of strategic products. This includes all aircraft and component parts, certain chemicals, certain generics, semiconductor equipment, certain agricultural products, natural resources, and critical raw materials. And we will keep working to add more products to this list. On steel and aluminium, the European Union and the US face the common external challenge of global overcapacity. We will work together to ensure fair global competition and to reduce barriers between us. Tariffs will be cut and a quota system will be put in place. We will also increase our energy cooperation. Purchases of US energy products will diversify our sources of supply and contribute to Europe's energy security. We will replace Russian gas and oil by significant purchases of US LNG oil and nuclear fuels. US AI chips will help power our AI gigafactories, and the US help the US to maintain their technology edge. Today, with this deal, we are creating more predictability for our businesses. In these turbulent times, this is necessary for our companies to be able to plan and to invest. We're ensuring immediate tariff relief. This will have a clear impact on the bottom lines of our companies. And with this deal, we are securing access to our largest export market. At the same time, we will give better access for American products to our market. This will benefit European consumers and make our businesses more competitive. This deal provides a framework from which we will further reduce tariffs on more products, address non-tariff barriers, and cooperate on economic security. Because when the European Union and the United States work together as partners, the benefits are tangible on both sides. At the same time, we are building a true foreign economic policy. And for this, we have started at home. We're taking bold action to make Europe more competitive, more innovative, and more dynamic. Our single market, with its 450 million consumers, is our greatest asset and our safe harbor, especially in turbulent times. We're also creating new trade partnerships around the world, expanding from the 76 we already have. We've concluded negotiations in the last month with Mercosur, Mexico, and Indonesia. In an unsettled world, Europe is a reliable partner, and we will continue to deliver deals that help safeguard our prosperity. Finally, I want to thank President Trump personally for his personal commitment and leadership to achieve this breakthrough. He's a tough negotiator, but he is also a deal maker. I want to thank Commissioner Maroš Šefčovič and his team for their tireless work and skillful steer. They've done most of the heavy lifting. And I want to thank our member states for their trust and their commitment. Our unity is our strength at home and abroad. We will continue to work hard for the benefit of all Europeans. Thank you very much.
Hello, welcome back to Global Business Insight, where we consider the headlines moving markets in more depth. First, some of the headlines. The US stock market was at record highs, with the S&P 500 notching a record close. That was on Friday in each of the past 5 trading sessions, up about 1.5% for the week. The tech-heavy Nasdaq also closed the week at record levels. Earnings from big tech that's ahead, with Apple, Amazon, Microsoft, and Meta, could help to get more upside, even as futures are already ticking up given the newly agreed EU-US trade deal. But there are still many drivers. Apart from a raft of earnings, along with Eurozone growth and inflation data, in the US, markets will focus on the Federal Open Market Committee, that's the Fed decision on interest rates. The Q2 GDP print for the US also comes out this week, and more jobs data. We also get the release of June's measure of the personal consumption expenditures price index. On the FOMC meeting this week, markets are not expecting a rate cut as the White House continues to demand for interest rates to be slashed. Profits at China's big industrial firms dropped for a second straight month in June. Earnings fell by 4.3% compared to the year earlier. In May, they sank by 9.1%. Companies are struggling to grow as Beijing cracks down on unbridled competition and spiraling price wars between firms. Talks between the US and China could take center stage this week, as earlier we got the South China Morning Post, that was yesterday, reporting that Beijing and Washington are expected to extend their tariff truce by another 3 months as we see trade talks kicking off in Stockholm today. Foremost entrepreneur and founder of Dangote Cement PLC, Aliko Dangote, announced his retirement as a director and the chairman of the board of directors effective July 25, 2025. Africa's richest man is relinquishing his position as chairman and retiring from the board so he can focus more attention on the refinery, petrochemicals, fertilizer, and government relations. The board of Dangote Cement PLC has therefore announced the appointment of Mr. Emmanuel Ikazobo, an independent non-executive director, as the new chairman board of directors, while his daughter Hajia Maria Aliko Dangote was also appointed to the board of directors of the company. OPEC Plus delegates are likely to keep current output policy at today's meeting, with a plan to increase production by 548,000 barrels per day in August. Oil remains, if you look at prices, it remains range bound, with many members producing less than their hike targets, also limiting the impact of quota expansions. From OPEC data, they still see decent demand for the second half of 2025, but also cannot ignore persistent uncertainties from soft economic data and slowing Chinese momentum. Brent crude still under $69 a barrel most of the weekend. Our deep dive is on the EU-US trade deal. President Trump and European Commission President Ursula von der Leyen announced the trade deal after negotiations in Scotland yesterday, with more details on the framework still to be confirmed. Apart from the 15% tariffs agreed, which includes for goods like cars, the EU committed to $600 billion investment in the US and will also buy $750 billion more in American energy. That's over 3 years. Steel and aluminium tariffs, however, will remain over 50% with a plan to replace them with quotas. The avoidance of a retaliation scenario is a relief to markets, and a slew of much higher tariffs earlier threatened by both sides have also not happened. And you could say the agreement creates some measure of stability. This is important for global trade as the US-EU trade relationship. If you factor both services and goods trading in 2024, it comes to 1.68 trillion euros. That's $1.97 trillion. And though the EU enjoys a surplus on goods trading, it has a deficit with services. So we get an overall trade surplus of around 50 billion euros with the US last year. Analysts see euro and equities having a catalyst, and they expect an upside rallying when markets open. There are still sectoral tariffs as probes are ongoing into industries including pharmaceuticals and semiconductors that could still result in new tariffs. Shifting more energy purchases to the US will help the EU win off from Russian energy at a fast pace. But what are the other broader implications of so much pledged investment into the US and the higher tariff environment? Higher cost of trade will definitely weigh on global economic growth in an already tepid growth situation. Also, it crowds out investment that could be going to bridge major gaps for investment in developing economies and Africa. Higher interest rates in the US could also imply higher capital flows to the US. Many African countries like Lesotho, suddenly faced with crippling tariffs, they are now an example of dashed hopes of low-income countries wanting to increase productivity and growth by relying on a particular export market and specific trade privileges to access that market. 20 years ago, the US showered Lesotho with development assistance and access to the vast US consumer market. All this has almost completely disappeared. Lesotho's trade minister warned that the country's textiles industry, a major exporter to brands such as Levi's and Wrangler in the US, risks having to fold up if Donald Trump's tariffs go ahead, especially these crippling tariffs on Lesotho. The present global trade scenario reemphasizes the importance of fast-tracking an African economic bloc. Size definitely matters for negotiation, and the integration of Africa and all the opportunities to look inwards for capital are also much more important. Better galvanizing of domestic capital and more de-risking to make Africa more compelling as an investment location. All these continue to be important, and an Africa Investment Summit to respond to the different environment, if not yet on the cards, certainly needs to be convened. The end of the era of aid can be a blessing in disguise if Africa wakes up to the huge economic opportunities still untapped. But this requires transformational thinking and leadership at a continental level to avert a more divisive nationalistic response and plays to weaken the continent's ability to respond to the different trade dynamic, where Africa can no more depend on preferential trade access arrangements. It certainly has to be competitive, and I think the integration of the bloc offers the best opportunity for competitiveness, for improving competitiveness. Even if a different US government emerges with a more generous approach to Africa, the lessons of today should not be lost. Asia-Pacific markets mixed as investors awaited more details on trade talks between the US and China set to kick off in Stockholm today. And European stocks rose to a 4-month high, with car makers spiking up after news that the US and European Union have secured a trade agreement. At the next episode, we will look at IMF latest forecast for the global economy to be presented tomorrow. Well, that's it on this special edition of Global Business Insights. This is Bode of Shosami.